Welcome to The Explainer, where we turn expert analysis into a story you can see. Today, we're going to dig into a major global strategy briefing from Morgan Stanley. We're looking at three huge forces that are pretty much reshaping our world as we speak. This idea of permanent risk, the wild next phase of AI, and of course, China's incredibly complex economic future. All right, let's just jump right in with this quote because it really sets the stage. When they say a permanent scar, they're not talking about a temporary dip in the market. No, the argument here is that we're walking into a brand new era where this kind of global friction, well, it's just part of the background noise of the economy now. So, what does this permanent scar actually look like day to day? Well, it's really about a deep fundamental shift in how the world works. And honestly, there's no better example of this than what's been happening in the Middle East. What's so fascinating here is this clash between what the market was hoping for and the strategic reality on the ground. The ideal scenario was simple. A quick peace deal, everything goes back to normal. But the new reality? It's messy. It's this drawn-out, stop-and-go conflict. Think of it like a low-grade fever that just won't break. It's not a full-blown crisis every single day, but it creates this constant friction for global trade. Okay, so here's the crucial takeaway. This new reality of permanent risk is forcing every single country and every major company to completely rethink its game plan. The old playbook was all about efficiency, right? Just-in-time supply chains, finding the lowest possible cost. Well, that's out. The new mantra is security first. It's all about resilience. So for us, that might mean the cheapest thing isn't always on the shelf, but the supply of really critical stuff is way more dependable. And this checklist, it really spells out what security first means in the real world. You've got countries scrambling to control their own energy, lock down their own supplies of key minerals, and build backups for their most important economic lifelines. The days of putting all your eggs in that one super efficient global basket? Yeah, those days are over. But look, it's not all about just managing risk. While all this geopolitical stuff is creating some serious headwinds, there's a massive technological tailwind that's picking up incredible speed at the exact same time. And yeah, we are talking about AI. It's moving into a whole new chapter. This definition just perfectly captures the huge leap we're seeing. Let me put it this way. Last year's AI was like a really, really smart college student. You could ask it a tough question, it'd go to the library, and come back with a fantastic, well-researched answer. But this new Agentic AI, that's a well-trained PhD. You don't give it a question, you give it a goal, a complex goal. And it figures out all the steps, the planning, the research, the tools, the execution, all on its own. And this isn't some far-off theory. The proof is right here in the numbers. Just look at this chart. In early 2025, only about 13% of public companies in the US were saying they saw real, measurable benefits from AI. Fast forward just 1 year, and that number has practically doubled to 25%. This is the inflection point. The economic value isn't a promise anymore. It's here, and it's happening right now. But you know what happens when tech gets this powerful, right? The challenges change. For the longest time, the whole game was about GPUs, the powerful brains that do all the heavy lifting. But with this new agentic AI, the real bottleneck is shifting to the CPUs in the memory. That's the command center that has to juggle thousands of tasks at once. And this one little shift, it's completely reshaping where all the big money in hardware is going. And this brings us full circle, right back to the physical world. For all its digital wizardry, this AI revolution is slamming into a very real, very solid wall: power. We're already seeing new data centers in the US facing electricity shortages of up to 20%. And suddenly, the most valuable assets in this new age might not just be the silicon chips, but the boring stuff, the power grids, the copper wire, the actual minerals in the ground. Now, when you start talking about physical resources and the massive manufacturing power needed for this AI revolution, well, there's one country that immediately jumps to mind. And that brings us to China, which is just the perfect case study for how these two giant forces, this geopolitical risk and this tech revolution, are crashing into each other and creating a really strange divided economy. The story of China's economy right now is really a tale of two completely different cities, all in one country. On one hand, you've got this incredible strength on the world stage. Their exports are booming, especially in things the world desperately wants, like green tech and advanced manufacturing. But then you look inward, and the domestic picture is so much weaker. Consumer spending is sluggish, and the property market, well, it's still going through a really painful correction. And speaking of the property market, you might see headlines about a big rebound in cities like Shanghai, but this chart tells a totally different story. When you actually break down what's selling, a whopping 80% of it is low-priced apartments. That so-called recovery, it's almost entirely happening at the bottom of the market, while the middle and high-end stuff is just sitting there. And this isn't even a national trend anymore. The whole market has fractured. You see some signs of life, some warming up in places like Beijing and Shanghai, but then you look at other huge hubs, Shenzhen, Guangzhou, Hangzhou, and things are still cooling off. You really can't talk about the Chinese property market anymore. It's a city-by-city story now. So, with all this chaos, all these moving parts, how on earth is an investor supposed to figure out what to do? Well, the Morgan Stanley briefing lays out a very clear and, I have to say, a very cautious playbook for the near future. The message for the short term is really simple. Buckle up. The next few months are going to be bumpy. You've got extreme market volatility, a super high-stakes US-China summit that could go either way, and then in July, a flood of shares from big AI companies are going to be unlocked and could hit the market. This is just not the time to be making huge, aggressive bets. But if you look out a bit further, towards the second half of the year, a more specific strategy starts to take shape. The preference is for China's domestic stocks, their A shares, over the ones listed in Hong Kong. And the focus is laser sharp on those sectors that are benefiting from both of the big trends we talked about. That's security first push and the AI revolution. We're talking green power, high-end manufacturing, and semiconductors. And all of this leaves us with one final, really provocative question. In a world where the limitless growth of digital tech is running into very real physical limits, and where security is suddenly more important than efficiency, is it time to completely rethink what a growth asset even is? Maybe, just maybe, the future of growth doesn't just belong to code, but to copper, to electricity grids, and to good old-fashioned concrete.